So good morning, everyone, and welcome to the Evoke Management and Nexa Law webinar entitled Delivering Profitable Growth. Then we've all heard of the saying, turnover is vanity and profit is sanity. Then in our world, it's all about profit, but increasing your turnover is helpful as well. I'm David Seaton. I'm the Commercial Director of Evoke Management and have been a serial entrepreneur for the past 35 years. So for those of you who don't know Evoke Management, then who are we? So we're a team of experienced finance, commercial and operation directors who work hands-on with SME businesses, actually helping to deliver what we advise. So there are lots of advisors out there that provide some form of strategy and then run away. Then we're there to hold our clients' hands all the way through their business journey. We work with businesses at all stages of their journeys, but it's always with the focus on increasing turnover, margin, and overall profitability. We have 3 questions for you to answer before we get going, just to make sure that everybody's awake. Then, and you'll see that you can just click on these immediately on your screen. The first one is, how optimistic do you feel about the next 12 months? So this is a business come personal, come all embracing. So please click and we'll see the answers straight away. Not at all. I should be looking for the face then on my screen to try and pick out who that is. Then I think that that's in keeping with pretty much what we're seeing in the marketplace. And there is a lot of optimism about what's going to happen in the business world over the course of the next 12 months. Next question. Are you considering M&A, merger or acquisition, as part of your growth? Definitely, maybe, no, I don't know. Vote now. So we've got about half of the people in the room then who are on their way to making that decision, and 10% haven't made up their mind yet, and a few who don't see that as being part of their strategy. And final question. If I can get the screen to change, there we go. Are you planning for an exit in the near future? Then, so in the next year, in the next 3 years, in more than 3 years, or no? But no. So quick show of hands. Who, if I asked that question to you personally, would say in the next 3 to 5 years? Hands up if that's what you'd say. Because it is the #1 sentence that we hear in our industry, then all day, every day. And I will always answer that with, in that case, you need to start now. It takes time to set the building blocks to make sure that you have a successful exit in that 3 to 5 years time. Otherwise, you will still be saying the same thing in 3 to 5 years. Okay, we're going to hear from 3 speakers today. Then 2 of whom work on growth delivery for many businesses, and the other is an executive chairman of a rapid growth organization who's overseen enormous growth over the past few years. Then after we've heard from all 3, there'll be an opportunity for you to meet the presenters in separate breakout rooms. So this is our version of what would happen in a real life networking type presentation. Then a chance to go and share a glass of wine with the presenters and discuss your own plans. So we'll do that in separate breakout rooms after the presentations. Then we are going to keep the webinar open until 12:30 rather than at 12. So if you do have the time to stay on after that and discuss your plans with our presenters, then we'd be delighted to hear from you. So moving on, then now I'd like to introduce you to Hugh Reynolds, then one of my colleagues from Evoke Management, who is going to talk to us about a practical guide to M&A. Over to you, Hugh.
Thank you. Can you see my screen?
Yep.
Okay. Okay. So, hello everyone. What I want to do today is to take you through a simple practical guide, which intends really to just be a kind of roadmap of the issues that you'd need to consider if you're going through an M&A transaction. And the first thing to recognise is that the M&A process, it does apply to both the buying and the selling side of things. Much of the process that I'm going to outline is really aimed around the buying side of it. And I know that many SME owners, as I think we just saw from the poll there actually, intend in most cases to move their business forward via organic growth predominantly. But one thing you really should recognise is that M&A is another weapon in the armour of growth. It's a way to scale up quite effectively. And then even if you're not considering buying yourself, it's actually also very important from the sell side as well. If you're looking to raise equity to fund growth or to exit at some time, you really do need to understand how to engage with potential buyers. And of course, very importantly, how they're going to think and arrive at valuations of your business. And so throughout that, important to seek the right guidance and advice, because M&A is certainly not an everyday occurrence. It's really not an operational side of the business. So certain skill sets involved in it. And the first thing is really to be sure of why people do M&A. There are many reasons, a few of them listing out here. Could be geographical expansion, seeking a platform for future growth, extending into a different region or a different country. It may simply be expanding the client base in terms of overall number, or more importantly, the type of client that you want to build up. Or you may be seeking to do some vertical integration into the supply chain. And often it's actually about gaining know-how expertise. Often that involves people, obviously, technology, IP, and certainly an area to consider if you feel that your own entity is fairly light on some aspects of that. It may just be, diversifying out into new products and services so you've got a better overall offering for the marketplace. But of course, the most important thing is it enables you to gain scale. You may actually be able to leapfrog other competitors in the marketplace as you do an acquisition. But even if you don't do that, you're still going to gain market scale and increase your own organization scale. And M&A is very clearly a great way to do that quickly. So it may well come about by an offer for sale, either a direct approach from someone to you, or it may be a more public offer to sale. But ultimately, it's all about getting a profitable investment opportunity. And as I say, it can be a great way to scale up quickly compared to organic growth, but it doesn't come without risks. And so it's very important to be ready to plan for it. So be clear on why and then plan accordingly. The other aspect is really being sure of what actually it is you want to buy. Now, typically it will involve the whole business. So that would be, as a going concern with the assets, the employees, all the contracts, many of the liabilities, etc. And that would really be typically referred to as a share deal. But you may wish to just carve out some specific assets out of an entity, and that is a possible way of structuring things. Obviously, a driver may be people, know-how, expertise, or a client list, and sometimes there's an ability to carve things like that out of a whole business, just part of it. But it may well be that to gain access to that, you're going to have to buy the whole business anyway. But the important thing is if you go through all of this, you're getting your why and your what very clear. It gets you thinking about whether M&A should be on your radar screen for a way of profitable growth. Then the next issue is identifying a suitable target. I think by going through the why and the what, that takes you through the whole strategic fit side of things. But one other area that's very important to consider is actually the cultural fit. Because if you don't get the right fit in culture between the two entities, you may find that the whole process goes off the rails. And if that's after you've made the acquisition, that could be seriously damaging. You need to understand the market fully in terms of the market share, technology, and also something else, which is the potential actions that competitors may take post an acquisition. They may actually be quite aggressive in terms of volume pricing or putting in extra capacity into the marketplace. It's just something you need to have and be aware of. But of course, it's very important to understand the target's relative position in the marketplace before you proceed with any acquisition. keeping your eyes open to where they fit in the marketplace. And then in terms of keeping eyes open, something else I'd recommend is that when you're identifying targets, it really isn't just a one-off exercise. You should be kind of doing this on a continuous basis. Sometimes it's often a very slow burn type of approach that ultimately leads to a successful M&A. For example, in the SME world, it may well be that a founder's considering an exit, not right now, but in 2 or 3 years' time. So if you're building up that relationship in the near term, that can help to secure the deal later on. So in terms of initial steps, especially important if it's a direct approach by you to a target, is make that initial contact, gain some information and find out whether the target is actually amenable to a discussion about selling on. Clearly, if that's the case, you're going to sign a non-disclosure agreement in terms of keeping the confidentiality and no misuse of the information. You also need to be very sure of the fact that your own organisation has the financial capacity to execute the deal. So you need to get that in place if you're serious about this. And also just consider what skill sets do you have in-house versus what you may have to source externally. And just make sure all of that is ready to trigger. You need to complete a high-level valuation of the business. Now, obviously, this could be via the use of some top-down multiples, such as sales multiples or profit multiples. But I would thoroughly recommend that you actually carry out a discounted cash flow model of some sort as early as possible into the process, because that is obviously a much more refined valuation methodology to complement multiples approach. If all that's good, then you'd make a reasonable initial offer, via a letter of intent or a memorandum of understanding. But this would all be subject, of course, to due diligence, because as you get into the due diligence process, that may well alert things to you that are going to change your view on pricing or terms and conditions. And obviously, you lay out the structure at this stage in terms of whether it's share or asset purchase, the treatment of the debt, any excess cash, and any normalisation of working capital. Synergy planning. For some strategic buyers, there will be an element of synergies in the deal because they can often add value, and these can, again, come from a variety of areas. Could be access to new markets that it's currently difficult for the original entity to enter, but on combination, it can happen. It may just be complementary sales geographies between the two entities, again, providing higher revenue on combination, or some sort of cross-selling of the two entities into each other's areas with their own products and services. And again, IP can often be a big issue here. It can actually leverage up future sales as well. If it's a manufacturing type operation or something like that, then production supply chain optimization can be a great source of synergies, actually, whether that's aging assets, whether it's just the scale of things or a geographical play. Often a lot of cost savings can be achieved by that. And then the other area to look at in terms of scale savings is overheads. Obviously, when you fuse two companies together, clearly you probably don't need two HQs, and there's probably an opportunity to slim down some functional costs. You may gain additional purchasing power for getting better supplier discounts when you have more scale, and scale can also lead to better financing capacity, maybe even lower interest rates, and an opportunity sometimes to get some tax synergies. In terms of due diligence, this starts off, I guess, with some of the finance side of things in terms of confirming what the historical statements are and assessing any future forecasts that the target's giving you. So it's very much a deep drill into all the financial statements, but it's certainly not limited to that. Due diligence straddles pretty much every function, the commercial side, the legal side, tax, HR, operations, IT and IP, in fact. And as you go through this, it will give you the opportunity to refine your estimate of potential synergies and therefore tweak your overall valuation. But the really important thing is it's a risk assessment. As you look at this target, you're finding out whether your high level view at the beginning is justified or not. And it gives you that opportunity to correct that and either via price and or via T&C mitigation. Then in terms of closing the deal, your due diligence is completed, you've got a valuation that's been refined and finalised, and it's very important at this stage to maintain your discipline. Stick to those deadlines, otherwise the thing could get derailed. Don't go too heavy on price at the last minute. There's an often a tendency of people, when you've invested a lot of time and effort, to kind of feel this deal's got to happen, whatever. but it is important to know, one, when to renegotiate terms. Obviously it's two sides to this, but still be hard on that. And also, if required, really know when to walk from a deal if it's not right. If it doesn't smell right, then it probably isn't. Offer and timing, again, it's all about the accuracy and the effectiveness of this, getting the price offer right, and then acting decisively once you're ready, and just making sure your financing structure is in place. Finalising all the T's and C's that are relevant at this stage to move the deal forward to a close, and again, keeping that focus on risk management. Last stage is successful integration. And it's important here to recognise the level of resources involved. You really do have to dedicate that, whether that's yourself as a founder or whether it's a member of your top management team. It won't manage itself. It needs to be planned for and then executed with the right level of resources. So you really do need a plan for it, a first 100-day plan, roll through that and stay agile throughout to adjust if needs be. And then finally on lessons learned, I think, whenever you come out of a transaction like this, always good to have a bit of immediate feedback of the process. What were the pain points? What were the things that did go well? And then something we used to do in a company that I work for is 2 years after the acquisition, we would actually look back versus our original expectations and see whether it's come in line with that. If it was below, are there any target actions we can take to turn it around? If it's better than, the lessons learned we could roll out anyway to other deals, best practice as it were. And then finally, really just to wrap up, what does success look like? It really is about a lot of heavy lifting at the start, doing that work, right from the level of the original strategic view through the identification of the target, due diligence and the like, and of course, negotiating the deal. Then as you move into integration, it's about planning for that and achieving those milestones. And if you do all of that right, then hopefully you'll be in a great position to reap the rewards of great growth, which is what M&A can bring. Thank you.
Thank you very much, Hugh. Then just quickly, I just mentioned in the chat, please feel free to comment or ask me questions that you might have as we go along. And also then somebody did ask me, are we recording? Yes, we are, and we'll share the recording and the slides with you after the webinar. So up next is Fraser McGee of Nexa Law, who's going to describe how to find and carry out your deal properly. So Fraser, over to you.
Thank you, David. I'm sharing my screen. Can you see it?
Yep.
Excellent. Okay. Thank you, Hugh. That was really interesting and very useful. And thank you, everybody, for taking the time this morning. I'm starting with my section, which I've entitled M&A, Finding and Doing Your Deal Properly. I should have underlined and will underline that word throughout this. I'm a corporate lawyer with Nexa Law. I have been 25 years practicing corporate law in law firms, investment banks, hedge funds. I've run a public company, and I've worked with entrepreneurs and family officers over the years, helping them with their businesses. So let me talk to you today about finding and doing your deal. Hugh's covered a bit of this, but let's remind ourselves why and what you're looking for. You're responsible entrepreneurs. You recognize the success of your business is relying absolutely on growing revenues and profitability year on year. You want to do it organically, of course. That's how you set out in most cases. However, what about when organic growth for your business is plateaued or worse? What is it that your business lacks? What impetus does it need to succeed, to become more successful in its sector, more valuable, to generate more profit? Is it people that you're looking for? Is it cash? Is it assets? Hugh talked about the long list of things that are catalysts for this. You could be looking for new customers or products or services. All of things which are out of your reach currently. But with M&A, you can add them to your portfolio. M&A has been a critical tool for growth for a very long time. For growth and for delivering shareholder value, which is your principal job. So once you've looked and thought about the why and the what fors, what about the how? How are you going to find these inorganic growth targets? And moreover, how are you going to value them? You're going to have to think about the correct resources. So bringing in the right people and the right processes, and I mustn't stress this enough, the right processes to this, doing it properly. So as to the how, well, you'll be looking for your perfect deal. Perfect might be strong. Some of our speakers will talk to that probably. David will talk to that later, probably a bit more practically. However, it requires a lot of effort. This is something which M&A is resource intensive. It's resource in time, cash, and of your own employees. It's not to be taken lightly. You've got to build a process, a strategy. You've got to think about how you're going to fund it. How long is it going to take? And who are your targets? How are you going to find your targets? So you've got to create an acquisition strategy. And that strategy must start with gathering a map of your potential targets. Who are they? Look at your target market, your participating companies in it, the products and services that you're looking at. It's an exercise, in practical exercise, in getting a wider net and then boiling it down to grade and rank. Look through your targets. Make the shortlist. This is the shortlist which you can take and the board will consider and further boil down through the hopper to look at those which really make sense in terms of valuation and what you're trying to achieve. What you're trying to achieve with your always thinking about your strategy, your mission, and your purpose. Hugh spoke about culture. It's hugely important. But once you've got to this process and you're developing your map, you've then got to think about engaging your corporate advisors, whether it's accountants and lawyers. They'll help you look, they'll help you find, and even places where you may have overlooked. Doing it properly with the right advisors. This slide usually gets people's attention. Nobody wants to overpay or worse, do the wrong deal. So again, we talked about due diligence. If due diligence is the only thing that I get across as being important during this talk, and that's been successful today, it is the process by which you as the buyer will understand and be able to apportion the risk in the transaction. It will help you work out your valuation, which in turn, of course, helps you understand your negotiating position to get the price right. There's a standalone valuation, which Evoke and others will help you with. That's what it's worth standing alone to probably the seller and the market. But what is it worth to you once you've thought about the strategies, the synergies that you are going to incorporate? Bear in mind these two valuations, because of course, the price you want to pay is going to be away from that which the seller wants to offload. Getting shareholder buy-in, getting management and shareholders from day one to buy into the deal is so important. Having dissenting shareholders or management is only going to delay, increase costs, and possibly derail your deals. Having on board sign-in is imperative. And I'm going to mention the price again, the consideration. Where's it coming from? Are you paying cash? Are you borrowing money? Have it in place as part of your strategy, and I'll come back to mention it again later. Here's a simple list of what do I need to close. I'm not going to go through this. We've already touched on 1 to 5, but where I do want to start is where the legals commence. We've talked about the due diligence and getting through that process, the acquisition strategy, boiling down your targets. This is about getting to engagement, so the letter of intention. What do you want from the buyer, from the seller? Mapping out exclusivity so that you've got time to work on the deal away from third parties, competition. Protections in the due diligence process. Again, it's so important. The legal, the financial, the cultural. You've got to do this work. That will all help you understand what the business is that you're really looking to acquire. What's in it? What are the risks? This helps you negotiate the sale and purchase agreement, the key document in this process. This maps out your protections and apportioning the risk, together with the disclosure process, where you limit your liability against promises made about the state of the business and the target for the seller. Going through this process can take a long time, months, even years sometimes for big corporate transactions. So be committed to this. Be absolutely committed. Do it properly. Have the right advice. Be prepared. And then you'll move ready to implement your finance strategy and close. It sounds like part of a process, but have that money ready. You will not believe the frustrations and the problems that are generated by people not being prepared at that stage. And finally, it's closing and integrating. It's signing the deal, but it's then the hard process again, which you talked about, which is the integration. I'm going to quickly wrap up with, again, I keep talking about properly versus not. So some deal bloopers. First one, again, due diligence is the number one. Take it seriously. It's not a foolproof process, but it will help you understand the risks. Some of those may not come to the fore. It's not foolproof, as I mentioned. I worked on a deal last year. We spent 3 months before the seller announced there was somebody with a preemption right. So they had the rights to buy the company. We didn't find out for 3 months. That buyer wanted, of course, to renegotiate. That was the end of that deal, and £200,000 and 3 months of work gone. Finance, I mentioned it. Do you have it in place? Again, I've seen transactions where unbelievably, even financial services companies, FCA registered companies, entering into transactions for large double-digit millions, only to be found out the week before closing that they have no money and that there was no chance of getting money. Again, hundreds of thousands of pounds, unbelievably wasted. There are instances where people, and again, you alluded to this, be confident in what you know, be confident in your advisors, because there will be a point where negotiation last minute, it will happen. Sellers wanting more money, more conditions. You've gone in there with a purpose. Often you're looking particularly for one client, one customer, one asset. There'll be a condition precedent to this. How many times do we roll up to the line and find out that, unbelievably, despite hopes and promises, that client won't be delivered to you on completion? Representations are made about, don't worry about it. It's all in hand. Let's just sign and pay. I've seen this happen. It happens, and then guess what? The consent never comes. The customer is never delivered. You've spent all that money buying half of what you really wanted. These are amazing things which really happen. And getting to this process properly, thinking about your protections, and listening to your advisors. Listen to your advisors on how to do this process and how to go through it properly. Diligence is your key. Your lawyers and advisors are there to help you with protecting and ensuring you get what it is that you're targeting. So on that note, I only have one last note on the properly side. If you're in the process of disclosure and you're getting close to the line, you're in the deal room. If anybody makes material disclosures in the last 12 hours, it's almost certainly a deal killer. It's almost certainly. So on that note, thank you again for your time, and I'll look forward to speaking to you in the breakout room.
Thank you very much, Fraser. I absolutely couldn't agree with you more. And you cannot overemphasize the complexity and the necessity of the due diligence process. And I have personal experience of that in selling a company of mine to a £1.2 billion market cap organization that you'd have all have heard of. I thought that I could probably handle most of this stuff myself, keep the legal fees down, make sure that the boat got bigger rather than smaller. And I got called to their head office to be introduced to their due diligence team. And there were 30 of them sitting in the room, 30, and me. And I had to make my excuses very quickly, shake hands and run away and go and get my advisors to deal with it. And it's desperately important to do that part properly. So over to our keynote speaker, then David Hornsby. Then David is the executive chairman of Ideagen.
My name is David Hornsby. I'm the executive chairman with Ideagen. Thank you very much for asking me to come and talk today. Yeah, I've been working with Nexa, well, with Ben Walmsley from Nexa for 12 years now. So we've together done lots and lots of M&A transactions. And as you see, as I walk through the presentation, M&A has been a very, very important part of Ideagen's growth. So a little bit about the business. We're a software company. We are listed on the AIM market. And we've, through acquisitions and our own developments, built a very powerful software platform to meet multiple industry standards, focused on regulatory and compliance for highly regulated industries. Life sciences is probably our fastest growing market at the moment, but we're also very strong in multiple verticals such as accounting, finance and banking, healthcare, aerospace and defence. Today, 250 hospitals in the UK and the US are using our products and services. 9 out of the top 10 accounting firms, 7 out of the top 7 global aerospace and defence companies, and 15 out of the top 20 pharma companies use our products. So from it's still a relatively small business, whilst we're growing very quickly. We're getting to a certain scale now. I think to have such a wide and extensive and deep customer base globally is a real testament to the business, both in terms of the products that we have and the people that we have in the company. So if we go back to 2009, when I first got involved, I invested in a very, very small business called Datum, which was a document management and workflow software business, which had a listing on Plus Markets, which is was a very, very junior stock market, which doesn't exist in that format anymore. And there was about 4 people. It was a sub £1 million revenue business, and it was loss making. And I like the IP and I like the founder. I invested in the business, and from that we established the Ideagen group of companies. And over the past 12 years or so, we've grown organically. And the really important part of our business is not that we just acquire a revenue, but we buy and build. So our strategy is buy and build, and lots of organizations buy and don't build. So whatever we acquire, we need to be able to grow and create value rather than just buying revenue. So today we're run rating at around 85 million of revenue. Absolutely agree with what David says about profit against revenue. Although lots of tech companies don't seem to care about profit, and it doesn't always affect their valuations. We're very much focused on profitability as well as revenue, and we run rating at about 28 million of EBITDA. Really strong cash flow. Over 100% of our EBITDA turns into operating cash flow. We're in a really good position where 90% of our revenue is recurring. That is recurring, not repeat. So it's already contracted at the beginning of the year, and effectively our customers pay to continue to use the software that they've previously signed up for. So it's something called software as a service, or more traditional customers have a support and maintenance contract with us, which is for software which is installed on their own servers. Today, I've talked about some of our big customers. We've got lots of customers, 6,000 customers across the world. Most of our new business is now coming from North America. So new business, 40% is happening in North America. We've got an operation out there, but not a huge operation. We sell successfully from the UK into North America. We're a net exporter which is great. The market we operate in, risk and compliance, it's a big sector. It means lots of different things to different people. We see our piece of it, which is quality, health, safety, environment, some document collaboration, as well as about 3 billion market opportunity. So at 85 million, we've still got lots of opportunities. It's a fragmented market. Since coming to AIM, we've made 18 acquisitions. We made 3 before coming to AIM. As I said, most of these, Ben Walmsley from Nexa has provided the legal advice and legal execution, and that's gone extremely well. In terms of our growth, you can see that that's been really consistent. I think this slide really highlights the importance of building value through acquisitions. So we can acquire revenue, and our revenue has been 50% compound growth in the decade, 2010 to 2020, and that's continuing through. EBITDA even stronger as our margins improve, so 58% there. But the real measure of success is the earnings per share, which drives the share price. So compound growth in the share price has been 35%. So when I originally invested in Datum all those years ago, the share price was 2 pence. It's now about 290 pence. So we've increased the value by 150 times. So if anyone had invested alongside me and put £10,000 in 2009, today they'd have £1.5 million. So it's been a great success. Investors have come in along the way. We funded acquisitions through equity placings originally. It's a number of a progressively higher share price, which is important. And then we've more recently used debt as we've grown. But actually, as you'll see later, we've quite recently done a placing to help with some of the initiatives we've been working on. COVID's really, this situation, the COVID situation. We just did a deal in February of last year, and we bought a small e-learning business, fantastic business, really high growth, and none of us even thought about not to do it because of this virus that was coming out of China. We just didn't think about it at all, and within 30 days from the transaction, we were in lockdown. And as a public company, we really had to respond quickly. We had to let the market know what was going on in terms of our growth, our numbers. And we were one of the few companies that actually put out a new number. Most public companies just withdrew forecasts, but we felt that we had a very strong defensive market position with excellent recurring revenues, in good markets. So we put out a new set of numbers, and they were not so much different to the numbers that were already out there. So we held our EBITDA on a slightly reduced revenue number. Aviation has obviously been significantly impacted through the period of COVID, and we've not won any new airlines, as you can imagine. But we've held the airlines that we've already got. So our recurring revenue has been extremely stable. A safety management system for an airline is absolutely critical. If they're flying one plane or 1,000 planes, or if they're flying parcels rather than passengers, they've still got to have a safety management system in place. So they still need to pay us a fee to use the product. Manufacturing's been severely hit as well, particularly automotive and aerospace supply chains. So we've had a lot of business through the supply chains of BAE Systems and Airbus, and you know, that's pretty much dried up for 6 months, but it's coming back. But we've experienced excellent growth in certain verticals as well. Life sciences, US federal. We have an internal audit product, which is strong in banking and finance, and that's done very well. Also, so you know, I think this is the importance of not having all the eggs in one basket. Multiple products across multiple verticals, which of course the M&A strategy has enabled. And also, you know, through this period, we've carried on with our M&A, you know, which lots of organisations have just sort of battened down the hatches. You know, I've gone on the front foot. I personally lead M&A as executive chairman, and if you include the deal we completed just before lockdown, we've done 4 deals, 4 M&A deals of various shapes and sizes, and our share price has increased by 40% since the beginning of COVID. And I think that's for a couple of reasons. Firstly, because we've continued to perform, but I think also investors have seen the resilience in our business model, you know, and our strength in our execution, you know, and the way in which we've, you know, been bold to firstly hold our forecasts, you know, in a turbulent market, which shows absolute confidence of management in the business, but also, you know, our ability to go and execute our M&A strategy in a virtual world. So if I talk about, you know, how we use acquisitions, we did a placing just before Christmas. We decided we wanted to go and raise some more money to do some more acquisitions. At that point, we were run rating at about 65 million of revenue on the run rate, and we set a clear plan for our investors. We're a public company, so this is all, you know, in the public domain, to hit 100 million of revenues by 2023 on the run rate. 90% of that needs to be recurring from software as a service or support and maintenance. Strong margins, great cash, and we felt we could get to 80 million through organic growth. So you're looking at a compound of around 10% a year over that period, which is really good considering the margins. We can go faster but make less money, or we can make more money and not grow at all. But we think the balance of 35% margins and 10% growth is very strong. And we thought at that point we probably therefore needed to acquire 20 million of revenue through acquisitions, which we positioned as 2 to 3 transactions. We decided that we didn't want to do any more debt, so we went to the market, our investors and new investors, for funding. We raised £50 million in a week. We were actually massively oversubscribed, and we were offered around 120. So we did scale people back. But again, you know, a very bold strategy within the environment, but you know, very well rewarded and very well received by our shareholders. So what are we looking for? You know, we're in a big fragmented market. You know, we're looking to do a couple of things really. Firstly, extend what we already have, so to improve our product. I'll call it our platform. Our platform is made up of a number of different products which we integrate together, and then we can offer across a wide customer base. So we might want to improve the breadth or deepen the offer that we have. So we'll look for you know, systems that will thread onto an existing capability, you know, and give us that additional functionality to solve different problems for our existing customers. Alternatively, I'll acquire stuff that we've already got, and migrate those customers onto our platform. And there, we're just really looking for recurring revenues. We're looking for customers, and we're looking for future cash flows. Profit is key. I'll talk a little bit about the valuation metrics we use. Many software companies are all about revenue growth. We're about revenue growth and profitability. Always by companies with decent IP that they own. That's always a bit of a minefield, ensuring that nobody's got rights over that IP. Particularly SMEs who've had contractors in, who haven't always got tight contractual arrangements with their contractors. Recurring revenue is king in this world of IT that we live in. Subscriptions, absolutely vital, and that will drive value. The more ARR, the faster that ARR is growing, the more valuable a business is. No earn-out, that's one of my golden rules. Or if there is an earn-out, it's so short-term and so simple. It's almost for optics and positioning, maybe to tie an owner-manager in for a very short period of time, just to reduce a little bit of the risk. But no long-term earn-outs. For me, that creates too many agendas. We have one agenda at Ideagen. We all need to be absolutely on the same page from the very beginning. So my valuation metrics, it always used to be about the EBITDA. So it was X times EBITDA, on the current run rate. Moving forward, we've started talking a lot about our ARR growth to the market. So ARR, annual recurring revenue, is now our key metric. The amount we'll pay for an ARR book will depend on how fast it's growing and how fast we can grow it, and what cash flows we can generate from that ARR. And also what the strategic value is of that company and that product to Ideagen. So we're paying anywhere from 2 times ARR to 5 times ARR. So 5 times ARR is a pretty big number. So Ben Wormsley and I completed a deal in the summer. He knows that I was very agitated about it, because we were paying 5 times ARR for a business which wasn't making any money. So we paid £15 million for a non-profitable business generating 3 of ARR. But we know within 20 months that will be 9 million of ARR. We'll be making probably 30 to 40% on that, because our salespeople will sell that product through our platform. So that was a great deal. Even though I'd have liked to buy it for less. We had to tell the market why we were doing it, of course, because they were wondering, why is David buying this business for 5 times ARR that's not making any money? So we told the market our growth plans, and it went down very well. We will always translate annual recurring revenue into EBITDA post synergies. So the minimum we would do a deal at now is 10 times. Sorry, the maximum we would do is 10 times EBITDA post synergies. So we'll always say to investors, this deal will generate X in the first full year of Ideagen ownership. That has to be at least 10 times EBITDA. You can see we've done a lot of deals. I'm not going to talk you through them all, unless you want me to. I think you do. Is there a perfect deal in here? Yes, I think there is. Pleasetech, March 2017. We acquired that for 12. It was doing about 4 of recurring revenue. It's probably doing about 10 or 12 of recurring revenue now, making about 50%. That, you know, if that was a standalone business, that would be worth 60 million now, I think. So that's that's been a fantastic deal. But all these deals have been good in their own way. I don't regret any of them. You know, they've all delivered, and they've all been the right things to do for the business at the right time. You know, most of these companies don't exist anymore, you know, because we've integrated. The corporate entities have been integrated, as have the products, as have the people. Integration is absolutely key for Ideagen. Otherwise, you just get stovepipes of people, and processes, and technology, you know, all around the country, all around the world, and there's no way you can get a valuable growth opportunity. Some of the deals that we've done, the most recent deal we've done was Huddle, which we acquired for 28 million in December 20th, 2 weeks after raising the 50 million. We spent 28 of it on Huddle at 2.7 times ARR. We'll generate, we think, 3.6 million of EBITDA in the first full year of ownership. So that's a very nice multiple for us. Qualsys was the deal that I was talking about earlier. Different deal. A really important product for us in our platform, replacing one of our legacy products. So we were prepared to pay the 5 times ARR. And WorkRight was the e-learning business that we acquired just before lockdown. 1.6 million of ARR. That should do 2.5 of ARR this year, and moving to 5 million of ARR in the medium term. Sorry, there is one other deal on here that we've just completed 2 weeks ago, called Qualtrics, which is a US quality management software company, which we acquired for $15 million, which equates to about 3 times ARR. That's really important for us as we try and build out our US management team. Some great people that have come along with that deal. Okay, so integration is key. I'm not going to talk through all this because I am running out of time, but make sure you integrate what you have. So M&A has been a really important part of our growth strategy. You know, we've got very clear valuation metrics. Integration is absolutely vital. Detailed MOU or heads of terms is crucial. That will set the deal. And you know, I will always try and act with absolute integrity. Once we've established the valuation, the metrics, I'm not going to start chipping people or nickel and diming owner managers at the last minute. That's not the way we want to work. And I'm also, absolutely prepared to walk away. I don't want to materially renegotiate a deal. If something's not right, we'll go, and hopefully go early. And of course, the right team and advisors, and Nexa have been, Ben Walmsley has been absolutely crucial to our success. Thank you. Sorry, I overran a bit there.
Thank you very much, David. I really enjoyed it. And in fact, I was very impressed until you said that you hadn't signed up any airlines over the course of the last year, and at that stage you lost me. Then I don't know what you're doing. And saying that, then keeping EBITDA steady and growing throughout all of those acquisitions is very impressive indeed. And so thank you very much for that. And give me just 1 second. Well, I actually share the right thing this time. Okay, so before we go into breakout rooms for any of those of you who would like to stay and talk to the 3 presenters, then there are a couple of next steps from our point of view. Then we talk to businesses every day about their plans and help them to realize their dreams. And I'd be delighted to have a 30-minute free consultation with anybody that would like it. And you'll see that there is a link to my calendar on the screen. We'll be sending you a feedback form and the slides and link to the video after the webinar And these links will be on there, so don't worry about trying to copy them off your screen at the moment. Then we'd also like to invite you to value your or another business for free, quick and easily, using the link that's on the screen there, evokemanagement.co.uk/valuemybusiness. It only takes 5 or 10 minutes to fill in the detail, and you'll receive an email back within a minute or two with an indicative value of your business. And or as I say, or another business if you know enough of the details to fill it in. And finally, feedback forms. We run these webinars frequently and are very keen to hear feedback on how you enjoyed it, what you thought worked well and what didn't. So please keep an eye out for those and send them back when you can.